Hi everyone. In the last video, I said that where we have the last video where we treated independent or indivisible projects. So we now come to a point whereby I said we are going to have a surplus fund. And the question now is, what are we going to do to this surplus fund? Surplus fund arises whereby you cannot fully utilize 100%, fully utilize the fund available. After combination of what of the project, you still have little fund available. So what are you going to do to that surplus fund? So in addition to the specific investment opportunity, there will be a general opportunity to invest surplus fund in the market, assuming equal risk, assuming we are having equal risk level. The rate of interest cannot be higher than the company's cost of capital. Otherwise, the cost of capital will found to do to increase. Under the single period capital rationing, it is not financially viable to invest surplus fund at a rate which is below the company's cost of capital. But in the case whereby the rate in which you want to invest surplus fund is below the company cost of capital, under single period capital rationing, what you should do is either you take the money, the surplus fund, back to the investors as well to back to the shareholders as either in form of bonus issue or in form of dividend. What I'm saying in essence is that we have two cases under capital rationing. We have single period and multi-period. In a case under the single period capital rationing, and we have where we have surplus fund. The surplus fund should not be invested, and you still have an opportunity to invest in surplus fund in other investment in the market. So you should not invest the surplus fund in an investment which the return is lower than the market interest rate. If the interest rate is higher than the company cost of capital, by that therefore, under single period, by that therefore, you should not invest the money in any other investment in the market. You either do take the surplus fund back to the shareholders in form of dividend or in form of bonus issue. That is under single period capital rationing. That is what am I saying? They're saying is that under single period capital rationing, you should not invest the surplus fund in any security, in any investment in any investment with the return will be lower than the company cost of capital. But under multi-period capital rationing, the case is different. We have a different scenario under multi-period capital rationing. So we can invest our surplus fund under multi-period capital rationing. It means it tends to do to regenerate and give us more return in the long run. So for investing surplus fund under multi-period capital rationing, so your net present value the formula for computing the net present value under multi-period capital rationing where you are investing the surplus fund equals to R times S all over K minus S, where R is equal to return from external investment. From external investment, where your S is equal to surplus fund, our S is equal to surplus fund, and our K is equal to what? To company's cost of capital. So, to now calculate the net present value of the surplus fund that you want to invest, so we use this formula R multiplied by S, where R is equal to a return from the external investment. You know, we said we can take the surplus fund external to the market and go and invest it. What is the return on that? On that investment? So you have the return multiplied by the surplus fund all over divided by what? By the company cost of capital minus the surplus fund. From there, so at the end of the day, if you have a positive NPV, it means what you should invest surplus fund. But in the case where if you have what negative NPV here, it means you should not invest a surplus fund. So that is how to treat what surplus fund, any multi-period, and other single period capital rationing. At this juncture, we have come to the end of the treatment of surplus fund in under capital rationing. So watch out for the next video. For our next video on another subdivision of the single period capital rationing, which is what? Mutually dependent or joint projects. At this juncture, call it a class. Thanks for watching and God bless. And if you have not subscribed to the YouTube channel, kindly click on the subscribe button. Thank you.